IPMI EMBA batch March 2022. We are from
Ramcharan.
I'm Mita.
Hello, my name is Gio.
I am Tenga.
And I'm Dodi.
Today we are going to talk about the book from Willian J'Oneil, and the title is about how to make money in stocks.
This project is one of our group assignment in corporate finance class, which is lectured by Prof. Sembel.
And we will divide this video into 4 sections, which will be explained by each of us.
So please enjoy the video and don't forget to like and subscribe and comment. Thank you.
Thank you.
Thank you. Willian J'Oneil is a noted stockbroker, writer, and entrepreneur. He founded the stockbrokerage firm Willian J'Oneil in 1963. He is also the founder and chairman of Investor Business Daily, an influential investment publication. Born in 1933, O'Neill was one of the first investors to include computers in his investment research and decision-making process. At 30, he became the youngest person to sit on the New York Stock Exchange, or NYSE. Let's start for the first section. In this part, we would like to talk about the key point in chapter 1 to 7. Willian J'Oneil created the investment strategy that called as canceling. Basically, the canceling strategy is an investment system for selecting growth stock by using a combination of fundamental and technical analysis techniques, which is an acronym of a 7-step process. Let's take a brief look into each criteria. C. C stands for current quarterly earning per share. The higher percentage growth of the company is the better company as a fundamentally. The general rule of thumb most investors is to look for a company with a growth rate 20% or more. A. The letter A stands for annual earning growth. The revenue that's generated by a company should preferably grow over a year. Most investors utilizing the canceling method look out for companies with an annual earning growth rate of 20% to 25% over the last 3 or 5 years. And new products, service, and management or events. A company should preferably be on a continuous path towards innovation and development. S. Supply. A company's stock should ideally be suppressed in supply backed by a strong demand. L. The letter L stands for leading. According to counseling, an investor should always look towards investing in a leading company and also in a leading industry. The strategy suggests the use of technical indicators like the Relative Strength Index or RSI to identify the leading companies in industry. I. Institutional sponsorship. An investor should always look into the institutional shareholding pattern of a company before deciding to invest in it. Last is M. Market direction. A large number of the companies listed in the stocks market tend to follow the current direction to trend of the market.
Now, let's come to that section 2. When to sell and cut the losses. Nature of investing, investment is buying and selling. You can win the game of investing without a good defense. To be a successful investor, you need to be right all the time. When it's right, win a lot. When it's wrong, lose a little. How to know when your stock buy is wrong? Price of the stock drop below that you pay. The farther it's going down, the higher the probability is a wrong buy. Strategy to be a successful: develop precise buy and sell the rules. Be disciplined, control emotion. Don't become emotional attached to the stock. Don't let losses scare you, learn with it. Don't be greedy, sell soon. Don't fight with, argue with the market. Forget ego and pride. Investor motto or stock are bad unless the price go up. Nature of selling. Individual investors have the advantage of being able to move out of stock quickly. Only realize profit when selling reality. Will never be able to sell at the exact top. Don't be upset because sold and stock still went up price. And selling to cut the losses. A good stock bought in the wrong time can go down in price as much as a bad stock. A stock going down in price, it is not a good investment. Better to sell and put the money in better stock. Every 50% losses, start with 30%. To recover from 50% losses, the stock needs to gain 100%. Cutting losses, reduce risk. It is like buying an insurance policy. If you didn't have an accident in your car, what is the car insurance money wasted? Send apply to the stock. Frequently to the stock, so turn right around and go back. That's frustrating, but doesn't mean you are wrong. When to sell and make a profit. Reason for stock to top and revert down. General market top, sector falls out of favor. Company condition change. Institutional money pushes stock up to unsustained level. Stock appreciates so much that it attracts a lot of buyers. When everybody that could buy have already bought, the only direction possible is down. Sequence of events at the end of the uptrend. Stock advance for many months, for 1 or 2 weeks, advance even faster. Loses steam and tops. First pull back from the top, rally but fail to recover to the top. Several pullbacks and fact relies to take out buyer. Sign of first decline from the top. Number of consecutive down days greater than number of consecutive up days. Break 50-day MA is a moving average. 200 days MA flattened. Sign of significant decline. Break the lower channel line on the way down. Lower channel line bigger, connect a low point of several months. Hit and shoulder pattern. Very reliable. Left shoulder, head, right shoulder. Right shoulder must be slightly below the left shoulder. Sometimes happen just after the breakout of the cup of shoulder pattern. In this case, the cup or shoulder base in the left shoulder, then top of the breakout is the head. And then guideline to hold the stock. Number of consecutive up days bigger than number of consecutive down days. Price stay in the middle of the channel lines. Decline bounce back in the 50 days of MA. Hold at least 8 weeks. If price increase 20%, more or less if only 1, 2, 3 weeks from fiber. Guidelines to accept. And if the stock develop a short pattern after a strong run-up from its breakpoint, stock trade in a tight range for at least a week, meaning that institutional investors are reluctant to sell. Easier to identify on the weekly chart, look like a small stroke of pen. Buy when the stock trusts higher or high volume. Keep the new position small so that average cost remain at least 20% below the current price.
Now, third section. In chapter 13 to 20, Willian J'Oneil shared about investing like a pro. There are 6 points that we need to remember. First, best stock model in year 1952 to 2001. In year 1952 to 2001 were the best America's investment model. Carefully study the graph listed and refer to them. It is an example that you should find in the future. The thin wavy line with the RS mark at the end is relative price strength line. Texas instrument for the example. Breakout of the cup with handle consolidation structure at $30 in March 1958 and gained about 760% in the following 26 months. Study price patterns and history will repeat itself. All models show the stock graphic patterns right before the point where you need to take a buy step. Second, looking the best stock using Investors Business Daily or IBD. IBD's entire focus is on solid database research and extensive historical model building to serve as example. It is a fact, not personal opinions. IBD also facilitates the selection of the best future stocks, more faster and easier to understand the behavior of stock exchange in general. Third, picking the best market theme, sector, and industry groups. The majority of leading stocks are usually in leading industries. Study shows that 37% of stocks price movement is directly tied to the performance of the industry group the stock is in. Another 12% due to strength in its overall sector. Therefore, roughly half of a stock move is driven by strength of its respective group. Fourth, watching the market and reacting to news. O'Neil discussed the danger of listening to financial television networks, stock tips, and the rumor mill. The best traders stay the course and avoid getting sidetracked by noise and emotional traps. Also covered it is the importance of keeping a journal detailing the market's reaction to various news events. Fifth, should you buy OPSI, Nasdaq stock, new stock, bond, and foreign stock? Most of them are very complex. O'Neil himself does not invest in these types of stocks. His experience shows that apart from being worthy of investment, some are risky and unsafe. So don't waste time on it. Don't jump in without first knowing how deep the pool is. Your money and skills will thrive if you concentrate on buying high quality stocks instead of distributing your investment across risks with little benefit. Do necessary research first before making a decision. Remember, there is no risk-free investment. 6. How you could make your million owning mutual funds. A mutual fund is a portfolio of stocks managed by a professional investment company. Investor buys shares in mutual fund and make or lose money based on the net profits and losses of the stock within the fund. The best way to make a fortune in mutual funds is through the power of compounding. Compounding occurs when your earnings generate more earnings over time, boosting what you invest. The longer the time the duration, the more pronounced compounding effects become. There is no right time to start investing a mutual fund. Think long term and focus on building capital that will compound over the years. So, those are 6 points that you need to understand to invest like a pro.
Now we come to the conclusion. Knowing how and where to invest to get the best returns can feel overwhelming for the beginners in the stock market. But by following the tips and tricks we've talked about from O'Neil's book, the chances to make money in stock market is very much possible in the long run. So based on today's review, we cover a lot of important things, and here they are. Number 1, the Can Slim strategy explain everything about selecting stock using the combination of fundamental and technical analysis. Number 2, the first step in learning how to pick big stock market gainer is studying winning stock of the past. Learn the characteristic of the most successful stock. Number 3, focus on stock with exceptional earning growth in the previous year. Number 4, a company that buybacks its own stock in the open market has confidence in its future growth. Use this as a good sign to invest. Number 5, focus on buying market leaders. To avoid huge losses, always get out of your losses by 8% below your buying price. Number 6, only buy stocks with a growing number of best performing institutional investors. Number 7, identify the market direction by understanding the prices of daily market indexes. Avoid investing in a bear market and be prepared to enter while the market is bullish. This can determine whether you win big or lose. Number 8, always cut your losses quickly and do not average down in price in hopes of price recovery. Don't get emotionally attached to any stock that losing your money, and clearly define your selling rules and follow them. Number 9, never borrow more money than you can pay back. Excessive debt can severely hamper your finance. So in the end, this book is like a guide to building wealth in the stock market. with proven tips for finding winning stock and avoiding losses. By learning from the past how to make money in stock, so as how to spot patterns in unpredictable markets and create profit from them. Thank you. And now we will close this review by quoting Willian J'Oneil word that today is not enough for us just to work and earn the salary.
To do the things we want to do, go where we want to go, and have the things we want to have in your life, we must save and invest intelligently.
In the end, we are from Ramcharan Group.
Thank you very much for watching. I hope you enjoy and like it.
Bye-bye.